Hello and good morning, guys, for a new episode of the Croissant Files live. I hope you're doing well on this Saturday. I don't even know what date. Yeah, April 12th. What a crazy week we had with the trade war going full steam, specifically between the U.S. and China. This is what we review. I consider the trade war between with the other nations basically more of a sideshow, because we know that the specific issue for the US is the global trade relationships with China. Everything else can be probably negotiated between the US and other countries, but it will be different for the US. So, very brief on the geopolitics, because tariffs are geopolitics anyway, so we'll focus on that again this week. So maybe 5 minutes on geopolitics, besides tariff, then move on to the economy and tariffs, and then the impact on the markets. So without further ado, like everyone says, let's start. So yeah, the illustration that I took, was just a week up and down, like really, really crazy. But anyway. So let's start. So, I mean, what this tariff trade war means is that globalization is over. Trump just killed it, basically. So we are going now into a multipolar world, I believe, because if Trump expects to reestablish the hegemony of the US around the world, I'm concerned that it will actually not happen. And Trump is more of a nationalist than a globalist, sovereignist than a globalist, if you wanted to put it that way. So we see what happens, but the reason why I mention this is that it might not get the full effect of the intent. Is that if the US believe it can coerce China into its own will, it will be probably very difficult to happen. We'll see why in a couple of minutes. But the result might be exactly what happened with Russia. Russia, was supposed to be totally annihilated by economic sanction. Everyone saw that it just didn't happen. And Russia found other way to sell its goods to other nations, and seems to be now stronger than it was before, and be totally independent from the West by now. So in the same context, talking about Russia and Ukraine, the U.S. military base in Poland is not shut down, but the U.S. is shutting down the base that was used to bring the U.S. aid to Ukraine. So the troops are removed, the equipments are removed. So so you've seen that Ukraine have totally disappeared from the news cycle. And it's very likely that it won't appear again until we have an actual peace agreement between Russia and Ukraine through the United States. Last piece on geopolitics. Trump admitted this week that actually Turkey had control over Syria. That Turkey was helping and financing the current regime when there were only rebels against Assad in the north of Syria, at the border with Turkey. So these guys are controlling Syria now, and Turkey is controlling Syria through its proxy, which is a big issue for Israel, obviously. Turkey and Israel never had really good relationships. And so Netanyahu and Erdogan have started speaking together about the status of Syria, hopefully to preserve the peace and try to avoid a future conflict that I kind of addressed in the last few shows. So that's basically it on the geopolitics, and I did it with in less than 5 minutes. Isn't that crazy? Probably, I mean, the geopolitics will take less and less space in this show for a simple reason. The hotspots are getting, let's say, not as warm, cooler, I would say. Yes, the hotspots are getting cooler in terms of direct conflict. The conflict has shifted to the trade war that again might escalate into an actual war in the future, but this is not the case at this point. The focus is on the trade war, and this is what we'll review right now in the economy section. So, what did we have this week? We had tariffs. Again, the global trade war with, tit for tat kind of reaction between the US and China. I've checked, I've read a couple of things this week about this, and what I was really surprised that on a weighted average basis, meaning that the export, the size of the export times the tariffs divided by the sum of the export. So it's kind of weighted average tariffs for foreign country. The US is at 2.2% only. That's the lowest. But the EU, for instance, is only at 2.7%. And China is at 3%. So yeah, so China is still above 40%, kind of above the US. But not, it's not the double, it's not the triple, it's not totally crazy. So I was kind of really surprised by this number actually. So we see that really the fight is about the supremacy on the world, but China is not likely to go down without a fight. China has really changed since it was, the factory of the world. It's not anymore. If you look at the GDP, the export, the part of the export in China's GDP, in 2006 only, it was 36%. Today it's only 18.9%. So about half of it. And if you compare to the situation of other countries in the world, many other countries have GDP depending on the export that are much higher than what China is today. For instance, you have Japan right above China at 21%. Significantly also, you have Germany, which is dependent at 43% of its exports, of its GDP, depending on the exports. We have Vietnam that is 87% on its export. So this is why we've seen when the trade war started that the Vietnam stock market totally collapsed at that point. And surprisingly, I was surprised that the Netherlands, Holland, or the Dutch, I never know how to say it, if it's the Dutch, if it's Netherlands, if it's whatever. So they depend on 88% on their export. I have no idea what they're exporting. Probably a couple of well-known hedge funds or tulips. I have no idea, but that's a crazy number. And if so, in terms, I don't want to bomb you with statistics, but there was a ranking about the dependency of countries about their export, and China is actually the 159th out of the 195 ranked countries dependent on the export. So you could say that they are not that reliant on the exports, and they have, they manage to diversify. So the way you can see this, the diversification, is to look at the situation of the global trade dominance on the right, on the US versus China. So in 2000 it was clearly the US, and it has totally shifted, specifically in Asia and the global south, so meaning Asia plus Africa plus South America, dominance is for China at this time. They managed to diversify their exports with other country, but the trade war tariff is very difficult to figure out to impact. It would require a lot of research to have a clear idea. But if you listen to many sides, some will say, okay, China is still dependent on the US export, on the US consumer actually. And others will tell you, no, they are totally diversified, so they're not impacted. So in that way, in terms of diversification, so there were these little statistics that was saying, so China's GDP exports represent about 20% of, so exports represent 20% of China's GDP. Sorry, I'll try to make it clear. And 60% of that is domestic value added. So not dependent on the US, for instance. And within this, within what's left, the US only represents 20%. So if you combine all these percentage together and multiply them, you realize that the impact on China's GDP of the US demand is only 2.5%. So at this point, you can say that China has, the mean to kind of, be not too much impacted by these tariffs. And this is probably what makes the negotiations with the US much more difficult than they are. So, in the context that China might not be too impacted, so China didn't hesitate to retaliate in terms of tariffs. So Trump implemented tariff, China retaliated with 34% tariffs, and then it went on and on like this. Like I said, tit for that reaction, kind of crazy. So. Given that China had retaliated, Trump decided that he would increase the tariffs on China by increasing by 104%. Then the next day, China retaliated again with 84% tariffs on dollar. And finally, yesterday morning, these 84% tariffs were raised to 125%. So China, like Xi Jinping said in 2020, they are not ready to be bullied into, surrendering on that trade war. So we'll see what happens, but this is exactly where we're going at this time. So you've seen that Trump posed tariffs on Wednesday, which had a huge impact on the market. Obviously, in my opinion, a little bit too much overreacted because the situation didn't change. But anyway, this is where we are now. So not a single side wants to concede any defeat. I believe that both sides cannot lose this trade war anyway. Because again, this is what will reshape the trade for probably the next decade. And China is the rising power, the US is the established power. And so we enter into what is called the Thucydides trap, when you have two global power that are aiming for hegemony around the world, or at least a multipolar world. So usually this starts in a trade war and this ends in an actual war. It's not new. Thucydides, it was before the Roman Empire. It was BC. So I mean, there's nothing new basically at this point. One point interesting in this war is that, and we'll talk about this, about the bond market, because this is where China has some leverage on the US at this time. So China retaliated with tariffs, and rare earth export controls, which definitely hurts the US, that is at this time totally dependent on the rare earth export controls in China. This is what I mentioned already last week, about 84%, if I remember well, is coming from China. And at the same time, China orders the banks to reduce the dollar purchase. In an attempt again to hurt the US and to control its money as well. We'll go a little deeper in that section in a market when I'll talk about the bonds, or maybe I can talk about the bonds already, because China is holding about what, 770 billion in US Treasury bonds. So many says that, okay, that's only 2-3% of the total debt of the US, but that's part of the liquid debt, meaning that most of the US debt is the government lending to itself through organization, administration, all that kind of stuff, when the Fed buys bonds. So basically it's the right hand lending to the left hand, which is why also there's inflation, but that's a full other story. So why was I saying that? It's because China, even with 2-3% of the US debt, probably owns maybe 30-40% of the liquid debt, the debt that is tradable on the market. Because I forgot to mention, so you have administrations, US organizations, government organizations that will never sell their treasuries. You have also the countries, European countries, Western countries that are totally linked to the US, that will not sell their treasuries either. And so that's how China holds about 40% of the liquid debt. So they can put pressure on the market with this debt. We don't know if this is the reason of the collapse of the treasury of the last few days. It loses about between 1 and 2% every single day. But that's a possibility. Everyone is starting blaming the hedge funds and the basis trade. I'm not sure about that. This is not totally consistent with the drop in the dollar, in my opinion. But maybe it's better to keep that for the next part. So, what did we have? So we have China that can put pressure on the US, definitely. And like I said at the beginning, that we may be in a situation where instead of forcing China to concede a loss in a trade war, this may simply only establish a multipolar world and two different economic parts in the world at this point, and we start seeing this again. For instance, that with that, the little article, Van Eck article that I've seen this week, which was mentioning that there is a de-dollarization again, because China has started trading energy with Russia through with Bitcoin. That is really interesting, and we had other countries starting moving to Bitcoin. Obviously, these are the countries that are not really big friends with the US and the US dollar. So Bolivia has started trading in Bitcoin. Even France, which is interesting, didn't start trading in Bitcoin, but what they are starting to do is that the surplus of their the nuclear energy production will probably, so there are talks about this, used to be mining Bitcoin. So all of this is pretty interesting, and again, we will go into a global reshaping of the world. Again, same idea about the reshaping of the world. So I won't talk much about the EU, adding tariffs on the US, specifically because I believe that yesterday the EU has already mentioned that they were ready to negotiate with Trump. All the friendly country to the US will accept a negotiation on tariffs anyway, so that was expected. So the nuclear option with US Treasury bond from China, I've already talked about this, but the other news on this is that China and the EU have started talking together about a collaboration, less tariffs, more trade, friendly trades between China and Europe. And between China and Europe, the main focus point was the tariffs that Europe imposes on China's electric vehicles to protect its own auto industry, which struggles to develop electric vehicles, to be honest. And so they have started having discussions about this. The idea for them is to remove tariffs and impose a minimum price for Chinese electric vehicles. But that's still in discussions, and this is not going. This has not gone much further than that at this point. So let me check my notes. I think we are pretty good with tariffs. At this point, obviously the consequence is on the uncertainty, economic policy uncertainty and volatility. They are, evolving in sync. At this point, both are spiking up. And what's interesting is the bottom right chart. Why? Because historically, the trueflation index, the trueflation index is an index of inflation that is kind of decentralized. It's not coming from a government-owned agency, and the inflation has been going down for significantly over the last few months. And usually the bond rates have been following and going down as well, which again is not what we see today, but this means that this is probably where the bonds should be in a regular market. Again, what people fear is the uncertainty. If we would have even if the tariff was just established, people adjust to the rule, this is now the new rule, we move on. What is really hurting the economy and the market at this time is the uncertainty about these policies and the change on a nearly daily basis at this time. So now we can probably move on to the market. Let me check if you have any questions, guys. It's 10:39, 10:40, and I'm already there. Okay. So we can move on to the markets. And the week was not that bad. The really bad week was the week before, went down around nearly 10%. This time we are up, about 5%. So let me take that slightly bigger. Not bigger me, bigger the screen. Sorry. Okay, well, how can I do that? Okay, let me check this. Okay, we'll do this like this. It will be easier for you to see. Well, anyway, so we have seen the market rebound. Most of it came after Trump mentioned that there would be a pause on the tariff. The market spiked about 10%. Then without much things changing, actually, which is kind of really ridiculous at this point. But at the same time, you still see that the VXX was still positive, so the volatility is still increasing anyway. Uncertainty is increasing anyway on the markets. Gold, another very big week for gold. So this is where we are now. It's it's volatility at this point. I think that if you have two or three things to remember about this chart, is that the rebound of the equity, obviously, associated to equity, you don't have the volatility that is receding at this point. Is still very elevated and even increased slightly despite the spike in the equity markets. The other point is that the bonds that are collapsing. Yes, you could tell me that it's obvious because the market is going down, you don't need a safe asset anymore. That's not true, because when the market was going down, bonds were going down as well. I think it's a different story there. And then you have gold, which is basically the only thing that goes up these days. What I wanted to tell you before going to the dashboard, just crazy how crazy it is. It's the volume of options reach about 100 million dollar contracts, which is the first time in history that we passed that level. We'll see later that in the economic activity indicator in the dashboard, we are at crisis level, definitely. What else can I tell you about this before going this? Yes, the bottom chart represents the net treasury futures by investor type, and you see that asset managers are long 800 billion, which is why there was a lot of talk about the basis trade, the unwinding of the basis trade recently, that could put pressure on bonds. Maybe I can elaborate on this during the dashboard, but as an introduction to the market this week, this is what I can say. I mean, the market started pretty bad. We had Tokyo markets were halted, Poland markets were halted. I believe at the beginning in the US we were down significantly, but very rapidly rumors about the pause on tariffs came and helped support the market until the rumors became true on Wednesday. But anyway, so what can I do? No, not this one, not this one. Yeah, this one. So market dashboard for this week, April 12, 2025. So let's go for the dashboard and the indicators that I usually show you. So what do we have here? So here we have, global, the major asset classes. So like I said, we've seen the S&P rebounding about 5%. After a week where it was down 10%, we still see the bonds going down. As a reminder, the bonds are in a 42% drawdown at this point since when the top was established in early 2002. When we had started having these issues with inflation. The dollar is sold at the same time, which tells me that the narrative around the unwinding of asset managers on the basis trade is not the full story, because most of these managers are US based anyway. They would not have to sell dollars by unwinding this basis trade. This is totally different if this is China that is selling its treasuries, because if China is selling those treasuries, they would receive dollars that it would have to sell on the market, which could put pressure on the US dollar as well. So you have gold that it's the only one that has been consistently going up since the beginning of the year. If you look at the year-to-date performance, the gold is already up 23%. And if you look at the others, I mean, the S&P is still down, bonds are flat, the dollar is down. The only other one, yes, the Bitcoin is down, and the energy is down as well. So, I mean, there is basically no place to hide at this point, maybe except gold. Well, or actually, this is where investors have been going to for a safe asset position. Probably a little easier to see this way, you know. So I didn't show really many, you know, historical charts. I was focusing on this, but I understand that, you know, looking at numbers might not be very, very sexy. So, and we might want some time to see how things unfolded. So if you look at what happens over the last 2 weeks, I would say we had this huge drop starting, you know, the beginning of April. You know, March in comparison was looking like a walk in the park. So we had this drop in the S&P. We had the drop in energy, because energy is the currency of global trade. You know, if no one trades and no one produces anything, you produce less. This obviously put pressure on energy price. So it's not a very big surprise to see energy going down significantly. You have bonds going down, you have US dollar going down. So, I mean, you know, what is funny, what I found funny actually, is when the market rebounded about 10% on, when was it, Wednesday. I can never even remember dates when it's only 2 days ago. But anyways, even when the market rebounded, it's, you know, it's part of the volatility that the market is currently experiencing. Many started calling a bottom because we bounced back 10%. But I mean, the situation, the general situation didn't change. Anyway, nothing material changed. The tariffs are posed. In a situation where you would expect the US to finalize agreement with its main trade counterparts. You know, if you think about Mexico, Canada, EU, you know, all these countries, it's very easy to get to the negotiation table and find an agreement. So it was just a pause, nothing changed, and the main actor in this trade war is not ready to come to the negotiation table. You know, Trump boasted about, you know, all countries calling. All countries but one, which is the most important at this time. So, okay, so what can I wanted to say something differently, but again, I mean, the really big thing is that bonds are sold across the board. So you have a higher sensitivity for the long-term bonds like TLT, for instance, than you have for mid-term bonds. The reason I wanted to tell this is because if it's again the narrative of hedge funds unwinding their basis trades on bonds, basically would have the same effects as the unwinding of the carry trade, for instance. The reason why I don't totally buy the narrative of it might be possible, but at this time we have not heard about any hedge fund liquidating or being forced to liquidate on loss on their basis trade positions. What we know is that China has entered into a control of its currency, which is again a sign of potentially them selling their treasuries on the market. And why do I say that? Because if they are selling their treasuries, they are getting US dollars, that they would have to sell to the market, so that would weaken the US dollar, such as we've seen, but it also strengthened the yuan, which in turn would hurt their exports. And this is another reason why that, I think it's a combined situation between potentially hedge funds unwinding their basis trade, China, benefiting from the opportunity to sell some of their bonds and hurt the market a little more, but not too much so that the yuan would raise too much. I believe if China sells, it's probably an opportunistic thing between the two. But my position is that it's probably a combination of factor. And based on the equity markets, it's interesting because when the market dropped more than 10%, nearly, we hit what people call bear market. When the market is down more than 20%. Briefly, it happened, I believe, at the beginning of this week. If not on the S&P, it happened on the Nasdaq, definitely. But what's interesting is that Trump didn't move at this point, move at all. But when the bond market started being hit seriously, in a couple of days, on Wednesday, Trump hit pause to try to stop the bleeding on the bond market, because the credit market is a much more systemic risk than any than the stock market, for instance, because if the credit market collapses, then the economy collapses. It's a much more, again, systemic risk than any other risk that you can have on the stock market, for instance. And I believe this is the reason why Trump removed and paused these tariffs so rapidly. And this is also a reason why, just to let's say illustrate what I was saying, you see that the US dollar is going down and every other currency is going up against the US dollar. Whether you have euros, the yen, the Swiss franc, for instance. The Swiss franc is probably one of the safest currency. More stable, if you're looking for a safe asset in currencies, the Swiss franc FXF that you see here is one of them. Australia is a little bit different. You saw that Australia was massively hit by the start of the trade war, but with the pause, obviously this lifted the Australian dollar in return. So this is the context where we are now. So let's move on. So yes, so I often so let's move back at the majors. Where are they? They are here. What I consider an important factor to look at when I'm looking at this is that what I call the sigma ratio, which is the ratio between short-term volatility and longer-term volatility, which indicates you that where the market is going in terms of activity and in terms of risk. So you've seen that, for instance, this week, despite the fact that the market went up 5%, this ratio still spiking up like crazy. So this is volatility. This is not, let's say, you can only say at this time, you cannot say it's a bottom if it's if we'll have new lows. Obviously, I have no idea about that, but the risk is increasing, and when you have risk increasing in the market, this is not the time to try to pick the bottom and double down, because this is how you go bankrupt. The only rational thing to do when the market risk is increasing like this is to reduce your position. So some will say, well, I will only, realize my losses and I will not rebound as well. This is a choice you have to make if you want to take the risk of losing even more, rather than, getting out, or at least reducing your position at reasonable and acceptable level. So, so I think that this kind of indicator is important because it tells you where the risk is, and even more important, where the risk is going. And at this time, it's still increasing. So it's probably not the time to be the hero. So, and this is why I wanted to show you this again. And like I said, looking at numbers is not always sexy. So I put these volatility ratios back into an historical context, and you see that they are spiking up in sync. Usually the market behaves normally. Some are going up, some are going down. That's perfectly fine. That's the natural, I would say, breathing of the market. What is concerning over the last this week, and even couple of weeks, is that you have the volatility spiking at this time. So the top one, you have the S&P volatility ratio spiking like crazy at 250, more than 250%. What does it mean? Is that the current short-term volatility is 2 times higher than what it has been over the last year, which again is quite significant increase, at least in my opinion, and even historically. If you look specifically at that number, you can see that this volatility ratio started increasing not at the beginning of April, for instance, but even before March, we were already in an ascending kind of trend. The whole month of March, we were rising again. If you remember the drop in markets in early August last year, we had a similar situation where the market was, this volatility ratio was rising before it culminated with the sell-off in early August. We had a similar situation even as early as early March, rising through March, nearly slightly pausing but still going up when the market recovered a little bit, and then again spiking up on this April market activity. What is interesting to note, in my opinion, is the same thing happens with the other major representative of other asset class, such as USO, which is oil, the US dollar, you also on gold, and the bonds as well. So everything is, all volatility ratios are going up, which indicates an increased risk in all asset classes, and we can have a better view if we look at this. So you probably don't see the red line because it's not strong enough. But anyway, I will try to explain it to you. At this time, so what is this first? This is the average. So if you look at the previous chart, this is the volatility ratios for every single representative of the major asset class. What I did is that I averaged this into a global volatility ratio indicator that gives you where we are in terms of risk and activity in the market at this point. And so the chart starts in 2007. And then we see that the current level, which is the red dotted line, that you may not see, but I will tell you that the current risk level is consistent with the risk level that we reached in October 2008, at the peak of the global financial crisis. We had the same peak in the 2011 crisis. I never remember if it was probably the European debt crisis. It was not the China, the Asia crisis, or maybe Asia. I never remember. I switched these two. So 2025, no, obviously, I mean, the 2020 COVID crisis peaked to the roof. We had a same level of risk and activity when the market started going down with inflation, so equity markets and bond markets going down, and then now we are at level that are consistent with the previous crisis. It doesn't mean that this is the top crisis, this is a bottom. It can always unravel more rapidly. However, I believe specifically after the 2008 crisis and what happened in 2020, and the reaction of Trump, recently about posing tariffs, because the bond market was not doing so well, and probably he wanted to stop the fire in the bond market. What I believe today is that this, for me, notes that they will not, Trump or the Fed will probably not let the situation escalate into something much stronger. This week we already had talks about from the Fed, that the Fed was ready to intervene if the situation in the bond market would escalate. So my opinion, and again, this is only my opinion, and this is, again, this is not an investment advice. I take the opportunity to remind you that everything that I say here is not an investment advice. It's not an incentive for you to buy or sell anything. And this presentation is mostly focused on the assessment of risk, which when you are a pro investment manager, you mostly focus on the risk rather than signal if it's going up or down anyway. But so what I was saying about the Fed and about Trump, at the speed that Trump posed the tariffs to circumvent the fire around bond markets, I believe personally that the Fed will intervene rapidly if that would escalate. And that's what I was saying briefly before, is that there are already rumors about this. Considering the situation in the bond markets, remember at the beginning of this week, there were rumors about pause in the tariff situation. These rumors were denied, and the pause actually happened. So now we have rumors about the Fed intervening on the market to support the bond market, and this, I have no idea if this is true or not, but I don't believe that the Fed or the government would let that kind of situation on bonds escalate, because again, this is a much bigger systemic risk than what we can have on the stock market. So if you look at the stock market, we have this big drop last week. So let me go back to this so that you can see better. You have bigger drop last week, kind of a rebound this week, but again, it's, in my opinion, only volatility. The VIX is still extremely high. We are again above 50, maybe not yesterday, but after yesterday, maybe not, but we are in the 50, probably 50 range at this time. So still very elevated levels of volatility, which tells us that as long as the volatility does not recede and start going down consistently, it's very difficult to say that we are out of the woods and this is over and we can move on. Again, as long as there is no agreement or settling of the situation between the US and China, this will probably be quite hectic for some time. So here it is, the market activity indicators on the S&P. You still see the volatility activity indicator spiking to the roof. It's very similar to the volatility ratio that I mentioned before. So not a surprise there. The volume is not really crazy. We usually have a lot of volume at the bottom. We don't see any spike in the volume, so I don't know, but this doesn't tell me that the situation is resolved at this time. Okay, bonds versus gold. If you talk about a safe asset, so we had bond versus gold. So bonds going down since early, even before, but the chart goes much long before, but it's going down at least since the beginning of 2024, when gold has been going up. So this tells you where market investors are going. And if you look at major assets versus gold, they are all collapsing versus gold. If you look at it, even despite the rebound in the S&P this week, it didn't make any dent in that downtrend of the S&P versus gold. S&P this week still made less than gold itself. So we have equity markets going down, whether they are US or Europeans. You have the dollar going down and bonds going down. So there's only one place to hide at this point, which can also be an issue as well, because we've talked a lot in the past few weeks about the concentration of the US equity market in the tech stocks and the Max 7, for instance, which is lower now, by the way, considering the drop in the market. But anyway, we may see a concentration of positioning into gold, just because, again, this is the only thing that goes up, and this is still a risk, because if everyone is piling up into gold, at some point, the market, when they will stop going down, when they will start recovering, there will probably be huge selling in the market. And I think this is the concentration, the positioning in the gold market that can be assessed by the commitment of traders reports, for instance. This was, I was talking about this with a friend recently. The commitment of traders reports tells you, if historically traders are positioned at extreme levels in one specific contract, futures contract. So that will be interesting, maybe in the next couple of weeks, to monitor that positioning, to see if we are in extremes levels of concentration of gold when and this is where the situation will become risky, because it's obvious that many people will pile up into gold just because this is the only thing that goes up at this time. What else? Yes, I could talk to you about the risk adjusted momentum. But we've been very long on the market dashboard. Well, it's interesting to me. I hope it's interesting to you. Let me check if there's any one single comment at this time. Yes. What's going on? I'm making a lot of sense again. Okay, thank you, Henrik. I didn't check much the comments. Sorry. So maybe last quick thing, and we'll be under an hour for this show, where you have the risk-adjusted momentum, and you see that even the gold risk-adjusted momentum is going down. Why? Even because gold is going up, because the volatility in gold is increasing as well, and so the momentum is reduced. When you have the volatility, it's a risk-adjusted. This is how usually commodity trading advisors are seeing the market, is the strength of the signal divided by the risk of the asset on which that signal is based. And what this means is that the risk on gold is increasing faster than its momentum. But we see that bonds that went positive in terms of risk-adjusted momentum at the beginning of this month went down again. The dollar momentum is collapsing again. The S&P obviously is still negative, and Bitcoin is negative as well, but it's usually non-factor much of this to see here, because the volatility is so high in this asset class that obviously its risk-adjusted momentum will always be very low, whether it's on the positive side or the negative side. And we can finish with this, which is the simple representation of the current situation on the risk-adjusted momentum. So we see that the S&P bonds, US dollar are down. This is what we've discussed basically the whole show. That only gold is up, Bitcoin is down, the energy is down. Again, this is what we've talked all about the show. So whatever way you look at it, basically we are in a risk, still in a risk off situation where everyone is piling up into the remaining safe asset at this time. So we have to be careful, because the volatility is high, a concentration in some specific asset is high. We have geopolitical situation that is moving like crazy these days between the US and China. I don't believe that we've seen the end of the story between this trade war between the US and China, and so probably more volatility to come. If I want to finish with basically a quantitative comment, number analysis of this, is that volatility is, we have a volatility clustering effect in the market. And what does it mean? Is that when the volatility is high, it tends to stay high. And when it can spike up very rapidly, usually the way down of volatility is much slower. So we can expect high risk for quite some time, again, until the negotiations happen, the situation is progressively resolved. But over the next week, I believe that better be safe than sorry. So thank you very much again for following this show. I hope to see you next week. We've done less than an hour, which is not too bad. The dashboard was much longer than expected, but this is justified by the market conditions at this time. So let me check. So I have a few comments, but that's only nice comments from friends. So that's perfectly fine. Okay. So thank you very much, guys. I hope you'll have again a very good week. I need to tell you, next week no Croissant Files live. My daughter is visiting, and I haven't seen her in 2 years. Maybe this is the first time she's visiting me and my wife since we moved to South Carolina. So I will focus my time on my daughter. She only stays for a short period of time. The Croissant Files on Monday will probably be very brief as well, but no live next week. unless the situation requires it and I spend 15 minutes on a video. That's a possibility, but it's very, very unlikely. So thank you very much. Sorry for next week, and see you in 2 weeks. Thank you. Bye-bye.